Everyone has different circumstances and everyone qualifies for a different mortgage amount. So you may ask, how do lenders calculate how much of a mortgage I qualify for and what do they base their decision on? While different lenders have different lending guidelines, there are three main things that lenders look at to calculate how much of a mortgage they are willing to lend you. Number one is the equity that you have. Number two is your ability to make the payments. Number three is your credit score and your history. Let's take a quick look at each of these. When a lender looks at your equity, they use a term called LTV, or loan to value. This is just a formula of the loan amount divided by the value of the home. So if you had an $80,000 mortgage on a home worth $100,000, you would have an 80% loan to value mortgage. This would mean that you had a down payment of 20% of the value, in this case would be $20,000. Let's look at another scenario. Say you were to put $40,000 as a down payment, you would ask the lender for a $60,000 mortgage, which would be 60% loan to value. The lower the loan to value, the lower the risk for the lender. That's because it's easier for a lender to get their money back if you were to default on the mortgage because there's more equity in the home. Their mortgage is more secure when there is more equity, and the borrower is less likely to default on a mortgage when they have more of their own money into the deal. Anytime that you have less than 20% as a down payment and the mortgage is higher than 80% loan to value, this is called a high ratio mortgage, and because it is more riskier to the lender, the loan has to be insured against default. When you have 20% or more down payment and the loan to value is less than 80%, no insurance is needed. The method that your lender looks at your ability to repay the mortgage payments is by using a calculation they call debt service ratios. There are two formulas they look at. The first one is GDS, is your gross debt service ratio, and is calculated by adding up all the costs to live in the home, such as the principal and interest payment, plus your property taxes, plus your heating costs, plus 50% of your strata fees if you have them. This is referred to as PITHS. They take this total cost and divide it into your total gross monthly income. You should not use more than 32% of your income to cover these costs. Your TDS is your total debt service ratio. This is your GDS above, plus all other monthly obligations such as loan payments, credit card payments, leases, or any other obligations you have. Your TDS should not be higher than 42% of your gross income. This leaves you 58% of your gross income to cover all your other monthly costs such as your income taxes, food, utilities, and any other costs that you may have. And the third issue they look at is your credit score and credit file. There's an old saying that the best prediction of future behavior is your past behavior. So the lender is trying to estimate your future payment habits based on your past ones. This is why it's important to keep a clean credit file and good credit score. We will go into details on these three steps in our next videos.